If you struggle to find good entries or price targets when you're taking trades, today I'm going to help you guys out by teaching you everything you need to know about liquidity. So in this first example, let's go over how liquidity works in a trending market, and we'll use an uptrend for example. So whenever you guys see pictures of an uptrend, you're going to see something like this, right? You're going to see a move up, and it's going to be some moves back down as well, but the overall trend is up. And notice how you'll never just see like a straight line up. It's always going to be some fluctuations. Now, why do the fluctuations happen? What causes these? So when you make a huge leg up, you're often going to come back down. Even if the overall market continues higher after that, you're often going to come back down, maybe chop around a bit, and then go back up. Now, why does that happen? Well, oftentimes what you're going to find is that on this leg up right here, for example, at some point we left some type of PD array, whether it's an order block or a fair value gap or something. So say we're looking at the 4-hour chart. We've got like 10 candles here. They're kind of small. And then we have one huge one right here. This candle probably left a fair value gap. And what price is doing is it's retracing back into that. So price always respects liquidity. That's why you have to understand that fair value gaps are a type of internal liquidity, right? We make a huge move up, we leave a fair value gap inside the range, and then we come back into it, right? To retest it and then move higher. What you want to do here is if you see price pull back into some imbalance, like an order block or a fair value gap, then you want to look to go long here as long as it's respecting that area. And what you're going to do is you're going to target the external liquidity, which is now this swing high right here. Price is usually in a strong uptrend going to eventually break that, and it's probably going to leave another fair value gap up here or something, right? If it's a strong move up, it's going to leave another gap, and we're just going to repeat the process again. We're going to come back down, test it, move higher. So that's the basics of an uptrend, just on surface level, how liquidity works inside of them. And if you're talking about a downtrend, you literally just flip everything I said, right? Price moves down, make a fair value gap, come back up, reject. It's the same thing. Now, obviously, like I said, you need to pay attention to how these fair value gaps or order blocks are reacted to, because sometimes we invert them. But if we're just looking at a daily chart here, you're probably going to see if price is coming back in and we're stopping the trend momentarily, or we're stopping the upside momentarily, we're probably filling or at least trading into some sort of imbalance. And if we respect it, that means the trend is probably going to continue. So I'm going to show you an example of the concept I just talked about so you guys can visualize it a bit more. We're looking at the NQ 4-hour chart. Now, ever since the tariff bottom, we've definitely had a strong rebound. So, we've been in an uptrend, and you'll see that it's not always so cut and dry. Higher high, higher low, higher high, higher low. It's not always that static. It's, there's some nuance to it sometimes, but this is an uptrend. The main thing you want to make sure you're seeing if you're looking at a trend and seeing if you're still in the trend is imbalances being respected, right? So right here, we have this 4-hour fair value gap. It's a massive one because this was the day that Trump paused tariffs. Now, as you can see, we did have a lower low here, even though we were starting our move back up. But the important thing about this is that we stayed in this imbalance. We never inverted, so we continue to respect this bullish imbalance. So even though you might see this lower low right here, relative to this one, right? If you're thinking, oh, it's an uptrend, you're expecting this to hold, right? This higher low right here. But you see this, you might think, oh no, are we downtrending again? Well, not quite, because we haven't disrespected this bullish imbalance yet. So that is one way to help gauge it, right? Like, it's not always so nuanced. It's not always going to be just a straight higher high, higher low, higher high, higher low if you're uptrending, but you will see that price does test these imbalances, and if they hold, then that can help you confirm the trend. We have another example, right? So we move up, we break out, we kind of confirm this bounce, and then up here, when we make some new highs and break out past the initial level, we have this fair value gap right here. Now, these two candles kind of count as one gap because there is no wick as a part of them. So we look at this and we see price retraces very aggressively into this. We test it, we bounce again, right? So this is kind of that theme I'm talking about, where we're moving up, we have a strong leg up, then we're chopping around for a bit, and then we move down to test it and we make a higher high. So you need to understand the importance of these fair value gaps, because they can be good areas to want to enter trades, and that's why I always mark them out. If we're in a trending market especially, you can really use these larger time frame gaps like on this 4-hour right here as a good way to confirm your daily bias. If you're uptrending, you can literally mark these levels out and say, okay, if we're trading down into here, I'm only looking for longs. And as you can see, I'm not going to zoom in right now, but if you go to a smaller time frame, this was the 4-hour chart, we test it and we just immediately rip right back up. There was definitely an entry somewhere in here on a lower time frame. And this kind of concept just continues to roll on. Right above the gap we just talked about, we have literally another one right here. Now I'll fix it a little bit, but you can see this big 4-hour fair value gap. What do? We test it multiple times and then make higher highs. Now notice, once again, yes, we did make a lower low right here, but that does not mean we're flipping the trend because the imbalance is still being respected. So just watch for imbalances like these fair value gaps or order blocks to be respected. That's what can help you confirm if a trend is still alive or not. Some people see this lower low right here and think that we're breaking structure or that we're going to start tanking. No. As long as the imbalance is still being respected, especially on a wick like this, you're fine, right? You're probably going to continue up. And you can literally just keep drawing this out, right? We had another one right here. What happens? We come down, make a low, respect it, make higher highs. Now, the last like week and a half, we've genuinely just been chopping from side to side. So there hasn't really been much of this, but I just gave you like, 4 or 5 clean examples of times where big fair value gaps on a larger time frame were respected in an uptrend and how they ended up leading to higher highs. And, if we're downtrending, you're going to find some here too that were respected as well and help take us to lower lows. But since the market usually goes up over time, you're going to find more bullish examples of this than bearish. But it is still worth noting that on a higher time frame like this, these gaps, these areas of importance make a huge difference and really matter. So you have to be marking them out. So quickly, I'm going to give you guys, using the replay mode, an example of how I would use and mark these higher time frame imbalances and how I do use them in my trading pretty much every day. I mark imbalances on the 1 hour, 2 hour, and 4 hour charts, maybe even 15 minutes sometimes if it's big enough. And what I'll do is I'll just mark them out and have them as a zone where I have bias. So in this case, you can see we've been chopping for a while, but we have this big bullish fair value gap down here. So my bias right now is going to be, let's not take a trade unless we're looking for longs inside of this gap. So we want price to trade back down into this fair value gap because once again, fair value gaps are imbalances. Market likes to revisit these. Now, whether they respect them or disrespect them is going to tell you a lot about if the trend's going to continue or not. But in an uptrending market like we have here, price is going to want to revisit this imbalance. It might not go all the way through it, but it's probably at least going to tag it. And once you can mark that out and recognize that, you're going to have a very easy time looking for areas where there's high risk reward opportunity. So if we go in the replay mode and we look at the very next candle, we get a big dump down into this fair value gap, and it's a bullish gap. So if the uptrend is going to continue and we see any long setups inside of this range, the risk reward here is very good, right? Because we have now tapped into this imbalance, yet we have a lot of room up to these previous highs. And if it is an uptrend, we're probably going to make a new high. So the next exact candle, we get a big move up. Right? We absolutely deliver perfectly out of this bullish fair value gap. We tapped down into it, respected it. This is good confirmation. The trend's probably going to continue. Now let's see where we go. So very next candle, we make a new high. The uptrend continues. We make a higher high. This is an amazing risk reward trade if you take it right here. So once again, this itself didn't provide an entry setup, but if you go on to smaller time frames, you're going to find them. That's the important part of going on larger time frames to mark these type of zones of internal liquidity out. And so this is just a perfect example, right? You're targeting this internal liquidity to enter a trade, right? Because you want to trade down to an imbalance. And then once you get that entry, once you get that setup, you're probably going to target this external liquidity right here, which is the previous high. And you can kind of do that in any trending market, and you're going to really allow yourself to succeed and find high probability setups. Now, what I'm going to be talking about is how to identify ranges. So now that you guys understand why fair value gaps, order blocks, and things of that nature attract liquidity, we're now going to be talking about the extremes of ranges, such as highs, lows, equal highs, and equal lows, and why those draw liquidity. So right here, I'm going to mark on NQ. This is an example of equal lows on the 4-hour chart. You can see that we have 2 lows right here that are the exact same. So you want to mark these and treat them as the bottom of the range you're looking at. Whenever you see equal lows or equal highs, mark that as the top or bottom of the range you're looking at. And then whatever area inside those is the high or low, mark that too. So right here, inside these, we've got a high up here, so we're going to mark that. Now you can definitely refer to them as highs and lows, but the formal term for it that a lot of people will use and that you'll hear thrown around is buy side liquidity and sell side liquidity. So buy side liquidity is the highs that you're referring to, and sell side liquidity is the lows that you're referring to. I just wanted to put that out there, so we'll type it out just so you guys can really visualize it. So this is buy side up here, And then down here at these lows will be the sell side liquidity. Now, I know these are equal lows. It doesn't have to be equal lows. It can just be a significant low that you're marking in a range, and that is sell side. So just know those terms as well, because people are going to bring them up. And just know that these highs and lows really tend to attract liquidity, and this works on any time frame. These external highs or external lows, right? That's the top and bottom of a range you're marking. That's what it is, external. Now you also have internal highs and lows, and these are just swing highs or swing lows that you can see are obvious. So right here we have this internal low. I'll mark it a different color so you guys can not confuse them. So in this green line, that's an internal low right here, right? It's a low. It's very obvious. It's a swing low that triggered a move up, but it definitely is not as low as these equal lows or lower. So it's an internal low. Now we have another internal high right here. This is an internal high. It's a good example. This move up actually ended up sweeping this previous internal high and this previous internal high right here. Now we'll see what happens after this, but just know that equal highs and equal lows especially are very good at attracting liquidity. Now, why is that? Because a lot of people have their stops here. They see this as a level of support. So market's probably going to want to come and take these out before it moves higher if it decides to. And you can say the same about the high right here that's very obvious, but I always say if you're looking at just a high and then you've got equal lows below, or just one low and you've got equal highs above, you should focus on targeting the equal highs or equal lows, because equal highs and lows are going to be more significant. Remember, it had a hit down here, so there's still going to be stops under this that hasn't taken out, and they're just going to add more stops here once we make this move down. So these equal lows, a lot of stop losses are sitting right below here, and market wants to take those out. Remember that. So as we can see, right here, actually, we officially invert the gap, right? We officially invert this bullish 4-hour fair value gap, and then we make a move straight down to these equal lows, take them out. Notice that's a sweep, and now we're going to move back up. So it's important to really recognize the importance of these levels, right? We end up having a bearish inversion right here. We sweep a high. We have a bearish inversion. Then we're coming back into this imbalance right here, right? It's an inverted fair value gap that's still an imbalance. We're coming back into this imbalance, and now we're starting a short-term downtrend down to these equal lows. Now, this would have been a perfect entry because you're getting a very bearish signature in price delivery, and what you're doing is you're saying, all right, we just inverted. We're probably just going to go down and take out these equal lows. Now, unfortunately, if you trade options, you probably know this move down actually happened on Thursday, which was Juneteenth, and the markets were closed. But it's just important to see this type of stuff playing out. It works, anytime. It works on Bitcoin, forex, gold, ES, NQ, right? These type of price patterns really work. And when you see these equal lows, even though we're so close to this high right here, you should know that you want to probably look for any reason to short, because we are most likely going to take out these equal lows before we move higher, especially because if you zoom out, we are in a longer term downtrend. And now we have a lower low, but we've also swept all of these equal lows. We wanted to get down there. The market wanted to take these out. Now, if it moves higher, I wouldn't be shocked. So as you can see, we did sweep. We ended up moving higher. Now we've come back down a bit since, but this is just a good example of equal lows and the way that they can be such a good target. And it's the same thing for equal highs. You want to look for these to be taken out. And then oftentimes what you're going to also see is a good way to enter opposite, right, once you sweep, because sweeps, if you get a bullish reaction right off of it, it's very bullish if you're sweeping lows. It's very bearish if you get a dump right down after sweeping highs. So pay attention to how price reacts, and maybe you'll also be able to catch a move the other way, right? That's the important thing, right? Every area of liquidity can serve as a good target and or entry point depending on how you want to trade it. Just mark them out because it's really important. So these equal lows, right? You could have had them as a target right here. You could even had this first low as a target and then gotten in some longs if you saw a bullish reaction on a shorter time frame. Or, you could take a trade targeting these, right? And you end up taking profits at the lows, and then maybe right after that, you're going to see, oh, look at this bullish reaction we're getting after sweeping equal lows. Maybe we're going to move up now. If I see something good on a shorter time frame, let me take it. So you can use these areas of liquidity that you mark out, especially equal highs and equal lows. You can use them as good targets and entry levels depending on your style. And I think that's the most important part of all of this. When you understand liquidity and where price is going to draw to, you can use it to fit your own style of trading, right? Because if you like to trade the trend, you can use this as an entry level. And if you're more into trading corrections or you're more into trading reversion, then you can use this inversion right here as a way to get in to a short and target these lows. So one really ideal way you guys can identify good ranges, right? Because you're going to see a ton of highs and lows all over your screen. You're not going to know, where should I mark the external high and external low? What range should I even look at? Well, if you're day trading, one of the best things to do before market open is mark the overnight highs and lows and use that as a range. So I'm looking right now. This is market open candle. And what you're going to do, like I said, is go to the overnight open and look and mark the high and low. So this is our range. This is the range we want to look for sweeps on. This is an external high. This is an external low. Anything inside of this that's developed is an internal high or low. Now let's see what happens. We're going to sweep, and I'm showing you guys an example of a recap trade where we do have my system of an IFVG. We are also in this case, a bearish 2-hour fair value gap. So I was looking for shorts up here, right? You see we are in this 2-hour bearish imbalance. So price is drawing back up to this, and I'm expecting us, right, because we move down, price draws back up to fill this imbalance out, and then I'm expecting us to dump back down. We'll see what happens. So notice we sweep this external high, and we end up developing a fair value gap on the way up. I'll mark this in green so you guys can separate them. And we end up inverting it right away. Then we move down, never close back above it, and we have just this nice move right all the way down to our target, which are these lows from overnight. And just understand that you can easily use these levels of liquidity as areas to target or enter your trades depending on your style and depending on your plan. Just know that it's important to mark them. You want to see everything. You want to know where price is going to attract to and where it's likely to reverse. And if you mark out external highs, external lows, equal highs, equal lows, larger time frame fair value gaps, larger time frame order blocks, you're going to be able to have a good understanding of exactly where price is going to retrace to and where it's probably going to end up going. Because at the end of the day, everything I just mentioned, all these points of liquidity are exactly that. They're areas of liquidity. Price wants to attract to these levels. Price wants to attract to the highs and take out the stops. Price wants to reverse and take out the lows. Price wants to come back into the higher time frame fair value gaps if it wants to continue a trend. Price wants to invert a fair value gap if it wants to reverse, right? So you need to be understanding that all of these type of PD arrays and highs and lows and points of control that you're going to map out, price is probably going to visit them in some significant way at some point. And once you get that, you're going to see a big difference in your trading. With that all being said, I appreciate anyone who tuned in, especially you guys who watched till the end. Comment liquidity and make sure to subscribe if you enjoy the content. I'm always posting educational stuff, helping you guys improve. That's my goal, teaching you guys and teaching myself in the process. I think there's value in that. So also make sure to join my free Discord, link in bio, if you want to trade with me live. It is free, no credit card, no email, none of that BS. Just click the link and you're in. But yeah, I'm trying to build a community in there. So if you're serious about trading, make sure to hop in. And with that being said, I appreciate you all. Peace.